Moscow is such a capital-intensive market in Russia in general, so the deal sizes are large, and so that's been a natural kind of limiter, and also it skews numbers, so you end up where averages and flows can be confused. We were just talking about this before the panel. I think that it's public knowledge that Morgan Stanley spent a couple $2 billion over the last couple of years, and so that number takes a big percentage of the foreign investment and cross-border activity that's been going on in Russia. But I actually see it right now, because of the geopolitical environment, being really going the other direction. I think you see a number of well-capitalized and growing Russian institutions that are formidable and serious, being the primary buyers. And it's a double-edged sword, because I think it would be a better market to have more foreign direct investment, to have more transactional activity, to broaden the market, and I think it would encourage other people to come into the market. And I think that that's going to take a little bit of time and a little bit more of the geopolitical environment to play through, because I think it's just pricing risk, and some people are viscerally opposed to it, and some people are interested. And you got to have a big checkbook to be able to be active in the market.
Definitely, we're seeing more interest and more money, but as Gordon said, it's mostly local, predominantly local money. Even the Novosibirsk shopping centre deal that we did was actually local money buying from American and Turkish money in developers. So it's certainly becoming more of a stable. There are more long-term Russian investors. Before, we had a lot of rather hot Russian money. Now it's becoming much more stable. I think we're going to. I would slightly disagree with the market presentation on logistics. I think logistics we have to be very careful about, because the main component is actually land, and if you look at Russia, especially even around Moscow, there's a lot of flat land served by major highways that is still there to be developed. There are barriers, but long term, I think there's an opportunity or risk for a lot more development. On the office side, I believe that what we are seeing is a lot of supply coming into the market this year and next. There's definitely going to be a competition for tenants. I believe that this will certainly have an effect on the rents of secondary property. Even the relatively recently developed buildings of the 90s and early 2000s are actually substandard. I think we're going to see a lot more diversification in rents. I don't see the prime rents falling, but I do see secondary and decentralized offices under quite a lot of pressure. And the big play is undoubtedly retail, and especially when we look at the regions where effectively we have the same tenants, whether it's H&M and Inditex and all the Russian retailers, or Auchan and Metro Group. We've got the same tenants right across the market, and yet we've got a significant premium when we move into the millioniki, the big local regional cities, and an even bigger premium when we move into what the Russians consider small regional cities of 500,000 people, which in Polish terms is 10 times the size of the average Polish city. And yet in the regional cities, the shopping centres are trading at around between 10 and 12%, depending on the exact cities and locations, and that is frankly a giveaway. But there are lots of opportunities. There are a few pitfalls. You need to be a little bit careful.